And now, family members and listeners alike, let's keep on pushing. And let's analyze the first part of 2017. Take a look at 2017 on the backside as well. And look at ways and means of getting P.A.I.D. as we roll into the second half of the year 2017. So here we are again at the halfway point in yet another trading and investing year. So what's happened? What's going to happen? Well, I'm not sure of what will happen going forward. I'm not a soothsayer. I don't have a crystal ball. But we can look in the rearview mirror and try to position our investments, position our trades as prudently as we can, based on what we already know. Now, a lot of variables can affect the outcome. We're talking about interest rates, the economy, the geopolitical politics, and the events that go on around the world, just to name a few. So right now, family members, you, me, we, the answer as well as you family and listeners alike, let's dive right in. Let's roll up our sleeves. Let's go to work. Please take copious notes. Now, midway through 2017, U.S. equity markets seem to be in the optimism business. As I speak right now, the Dow is up 25 points, the S&P 500 is up 0.21%, and the NASDAQ is also up 0.19%. Now, year to date, the S&P 500 index has climbed 7.6% on a price basis. Annualized, that puts us on track for better than a 15% return. But will we get there? Well, that's a good question. The forward PE of the S&P 500 currently sits at 18.7, not too terribly overvalued. Now, if we can get through the summer doldrums without any surprises, okay, we could at least get pretty close. Now, the real story in stocks, though, is international. The MSCI EAFE index, which is one of the best measures of developed market performance, has turned in an impressive 12.3% year to date, leaving the S&P in the dust for sure. Now, it may be too late to jump on that particular trade, but you can still get exposure to the theme by sticking to mega cap multinational stocks that derive 30% or more of their revenue from overseas. Did you hear me now? That's a smart way to get paid, okay, from the international market. Once again, stick to mega cap multinational stocks that derive 30% or more of their revenue from overseas. Now, the likely suspects are names such as Unilever, trades under the symbol UL, Coca-Cola, trading under the symbol KO, and Procter & Gamble, trading under the symbol PG. Now, these names own the most recognized brands on the planet, and they're defensive in nature as they fall in the consumer staples bucket. And even better, all three throw off an average dividend yield of 3%, which is our cutoff on our dividends. Now, another globally focused choice is a closed-end fund, a CEF, and I talked about CEFs Tuesday during our Classroom Not Walls radio broadcast. I broke CEFs down, told you how to pick certain CEFs like the uber wealthy to get your P.A.I.D. Now, as of late, I've been gravitating towards Voya Global Equity Dividend and Premium Opportunity Fund. It trades under the symbol IGD. Write this down. Voya Global Equity Dividend and Premium Opportunity Fund, trading under the symbol IGD. Now, this particular fund holds big global brand names such as Apple, Cisco Systems, and General Electric. And in addition to trading at a 6.8% discount to its net asset value, the fund throws off a healthy 9.8% income stream. Now, its financial health is protected by the fund manager's use of a conservative cover call option strategy to manage volatility and juice up the yield. Once again, Voya Global Equity Dividend and Premium Opportunity Fund, symbol IGD, to get your P.A.I.D. going through the second half of 2017. Now, I've been listening to and several of the pundits and the talking heads on TV lately ranting and raving about interest rates, okay? Now, even as the Fed raises rates and slowly unwinds its humongous balance sheet, the market will pay little attention. And let me tell you why. You see, family members and listeners alike, there is so much cash out there, it has virtually zero velocity. Too much supply and not enough demand, if you will. Now, while the 2008 financial crisis unfolded, the Fed and other central banks around the world opened the cash register and the spigot for cash and provided the liquidity markets needed to stay afloat. They accomplished about half of their mission, however. Financial markets stabilized, preventing the Great Depression, if you will. However, the massive liquidity did not translate into rapid business expansion fueled by banks lending mountains of cash to businesses and consumers. No, instead, banks have held back, becoming conservative. Consumers have spent less and saved more. You see, the demand for money just isn't there, resulting in a slow growth, type of economy. And while savers seem to be more diligent than they were pre-crisis, we're talking about pre-2008 and 2007, they aren't being rewarded. If anything, they're being punished by miserably low interest rates. That's why it's so wonderful when we make 600 and 900% profit, in 24 hours. Now, based on the collective opinion of most pundits out there, the Fed probably has one more rate increase in store for 2017, and they think it's going to happen in December. Now, until then, young entrepreneurs and then just basically traders and investors alike, they are looking for yield, and they are hungry for this yield, and they will be looking for ways and means of generating and receiving that yield. Now, it's been difficult to find value in individual names, as it relates to real estate. Now, I'm moving to real estate because some people are thinking, well, real estate is a good way to try to get a yield since regular markets yields are so low. Now, listen to me closely, because there's an intelligent way and an ignorant way to invest in real estate. Now, the best way to invest in real estate right now, is to invest in real estate investment trusts, or REITs, and utility spaces. Now, shoppers would be best to stick with tried and true closed-end funds like, write this down as it relates to real estate, this closed-end fund, CBRE, Clarion Global Real Estate Investment Trust Fund. It trades under the symbol IGR. Once again, CBRE, Clarion Global REIT. It trades under the symbol IGR. And the Gabelli Utility Trust, which trades under the symbol GUT. That's Gabelli Utility Trust that trades under the symbol GUT. Both of these funds throw off a combined yield of 8.2% and are expertly managed. So the smart way to get into real estate is that IGR, that CBR, Clarion Global REIT Fund. And then utilities, they're the cornerstone of most people's investments who are wise investors. And we're talking about that Gabelli Utility Trust, symbol GUT. Now, of course, the biggest variable that could potentially affect financial markets is the current geopolitical politics climate that's out there. Now, due to the steep learning curve faced by His Royal Highness and his administration, talking about Donald Trump, U.S. defense and foreign policies are murky at best. After missing a handful of opportunities to articulate Americans and American intentions on a global stage, it appears as if traditional U.S. allies are considering alternatives when discussing collective defense. Now, this isn't good for global stability, and that lack of visibility will eventually show up in the financial markets in the form of volatility. Now, the good news, my beloved family members and listeners alike, is that the political trend towards status populism has ebbed somewhat thanks to election outcomes in France and the Netherlands. Now, despite obvious buyer's remorse, the UK is lumbering towards an orderly Brexit, meaning that much of that effect has been priced already into the market. Now, while the situation in North Korea is indeed worrisome, the real flashpoint to watch is the mounting diplomatic crisis in Qatar. Now, listen to me closely, because a lot of people are missing this. You see, a longtime U.S. ally in one of the world's most contentious regions, Qatar has found itself isolated from its Gulf state neighbors due to and perhaps unfounded suspicions of Qatar meddling with the stability of regional governments. Now, the nation, talking about Qatar, is suspected of directly or indirectly providing assistance to opposition groups within Saudi Arabia, Egypt, and the United Arab Emirates. Now, while this is a complex story, it has more potential to become front page news. The situation, family members, bears us watching and monitoring it very closely. You see, the world does not want Persian Gulf allies quarreling amongst themselves. Now, on the energy front, as we go over and go deeper into the 2017, and I'm giving you things to look for during the second half of 2017. On the energy front, oil prices are in the same boat as interest rates, not going way up anytime soon. And after a strong start to the year, the price of a barrel of West Texas Intermediate, or WTI, has tumbled nearly 19% to around $44 for a high of near $55. Now, although the sector has bounced back nicely after 2014's energy bloodbath, North American shale production has become cheaper and more efficient than it's ever been. Now, this keeps the supply of the black gold, talking about that oil, it keeps the supply high and has forced prices back to within shooting distance of their 2016 lows. Now, oil prices and energy stocks are more likely to go lower before they go higher. So now listen to me closely. Therefore, for right now, one of the best places for energy exposure to get us P.A.I.D. is the Alarin MLP ETF. It trades under the symbol AMLP. That's the Alarin MLP ETF. Trades under the symbol AMLP. Now, this particular exchange traded fund, which is a macro position, offers you, me, we, the ASK THE WIZ Wealth Institute family and listeners alike, a basket of energy infrastructure and related master limited partnerships. Now, shares trade at a 11% discount to the 52-week yield, or the 52-week high, and they yield of 5.7%. Once again, shares currently trade at an 11% discount to the 52-week high and yield 5.7%. So, family members and listeners alike, let me wrap this up for you. Listen to me closely. At mid-year, I'd say, well, so far so good. Yet we should remain cautiously optimistic. Now, low inflation, persistent, negligible interest rates, and a lack of government interference have set the stage for a positive year in United States stocks. International markets have already delivered handsomely. The question is, can they both follow through for the second half of 2017? Because as I remain cautiously optimistic, I still think the best plan for you, me, we, the ASK THE WIZ Wealth Institute family and listeners alike is to focus on high quality and consistent income producing positions. Equally weighted, all of our stocks and funds, okay, that I've just mentioned to you right now for your possible consideration for inclusion to your portfolio, okay, they are yielding cumulatively 6.7%, okay? That is outstripping the 10-year Treasury note by what? 182 points, or 182%. And the S&P 500 average dividend yield by 233%. We need to think like this because we need to be better safe than sorry going into the second half of 2017. So there you have it, a complete review of what we need to be monitoring going into the second half of 2017. For this will be another extremely good opportunity for you, me, we, the ASK THE WIZ Wealth Institute family, to get P.A.I.D. And what I want you to do, my beloved ASK THE WIZ Wealth Institute family and listeners alike, is understand and overstand. As you put that third eye and that third ear on any position you think about actualizing or buying to open, listen to your spirit as the ancestors guide you to make appropriate decisions that will enhance your profits and get you P.A.I.D. Remain humble, maintain the right moral, physical, and spiritual intent, and know that profits like today, 600 and 900%, are from the Most High and the ancestors. And they will indeed speak to you, but you must listen. You must be in the position to hush, hush, when they're calling your name, to find out exactly your assignment and what you must and can